Very good morning, all of you. I am Dr. N. Saranabhavan, Faculty of Commerce, VIT, Vellore. I am indeed pleasure to welcome today's chief guest, Baskaran sir. Is a practicing chartered accountant for last 25 years. He served various posts, including Senior Manager Finance at CMC Vellore. On behalf of the Department of Commerce, School of Social Science and Languages, VIT University, welcoming you, sir, for this session. Even his busy schedule, so once we made a request and he accepted his consent in even this holiday. So similarly, I also welcome to our students on this particular session. The session is very useful because the topic is given like this: capital gains and its exemptions. I hope at the end of the session, all of you are going to get a brief input on this particular topic, because these topics are very important not only for nowadays, for all the days, okay, till end of your life. So whenever you are going to invest in terms of capital assets, so when you are going to transferring of your capital assets during the particular year, so what kind of capital gain we earn, what kind of exemptions we can able to avail. So these are all the topics SAR is going to give a brief input on the next 1 hour to 1.5 hour session. So once again, I am welcoming you, sir, for this session. Thank you all of you. Now the session is over to Baskaran sir.
Thank you, sir. Good morning to one and all. I am Baskaran, chartered accountant by profession, and I am just going to deal with the salient features of capital gains and its exemptions. See, before just discussing the exemptions in respect of capital gains, we should know what is capital gain. What is capital gain? The gain which arises over the transfer of capital asset is called capital gain. So there are two important things we have to note down. It must be a capital asset, point one, and it must be transferred during the previous year for some consideration. Then there is a question of capital gain. In other words, what the asset which is not a capital asset, then there is no question of capital gain, point one. And if it is not transferred from the transferor to transferee, then it is not a capital gain. So to find out or to compute the capital gain, there are two important parameters we should just note down. One is the asset must be a capital asset, then it should be transferred during the previous year. Okay, what is capital asset? As per section 2, subsection 14 of the Income Tax Act 1961, the term capital asset includes assets of any kind held by the assessee, whether it is connected to his business or not. That means all are capital assets. Then Act has given some exemptions. Of course, for example, personal effects, stock in trade, etc., etc. So land, building, furniture, fittings, so all are capital assets. If you are going to sell it for any gain, then it is a subject to capital gain. And it is very essential, it must be transferred during the previous year. If there is no transfer, then there is no question of capital gain. It implies that the asset must go from transfer to transfer. That is very, very important thing in the capital gain. So, first question, what is capital asset and how it is going to be transferred? Okay. Now, there are two types of capital assets under Income Tax Act. One is long-term capital asset and next one is short-term capital asset. What is long-term capital asset? Any asset which is just sold after 3 years from the date of acquisition, it is a long-term capital asset. In the case of immovable properties, 2 years. And in the case of bonds, instruments and all, 12 months, nothing but 1 year. So there are 3 periods you just keep in your mind. Normally, if any capital asset is transferred after 3 years, it will become long-term capital asset. In the case of immovable properties, 2 years. Other securities, instruments, bonds, etc., then it is 1 year. So you may ask me, what is short-term capital asset? Very simple. The asset which is not a long-term capital asset automatically become short-term capital asset. There are 2 types of assets. You may just ask me, sir, what is the significance of this bifurcation? You please understand, long-term capital gain is going to be taxable at the rate of 20% normally under the Income Tax Act. And in the case of short-term capital assets, except in certain cases, it will be taxable at a normal individual rates. This is the magic. It implies that long-term capital gain is going to be taxed at a flat rate of 20% normally under the Act. Short-term capital gain, except some cases where the short-term capital gain is going to be taxable at a flat rate, it is normally taxable at the normal individual rates, that is up to 2.5 lakhs exemption like that. That means we have to apply the individual rates. This is the major difference between the long-term capital gain and the short-term capital gain. Then, as I already told you, the asset must be transferred from one person to another person. There are certain cases where Act has specified that it is not a transfer. For example, under the gift, the donor is just giving one particular asset to donee as gift, then it is not a transfer. By way of will, any asset is going to be transferred, it is not a transfer. So, if it is not a transfer, then there is no question of capital gain. At the time of, for example, at the time of a partition of a HUF, either it's a partial partition or a full partition, if the assets are going to be allocated to the members of the HUF, then if the HUF is going to get any gain, then it is not a transfer, then there is no question of capital gain. So, the very important point is we have to know that whether it's a capital asset or not. Then 2, it is a long term or short term. Number 3, if it is a transfer from transferor to transferee. Then you may ask me, sir, if the asset is going to be, for example, there is a damage or damage due to earthquake, hurricane, or whatever may be our asset, then asset was insured, then automatically the insurance company is going to give the claim to us. In this case, actually there is no transfer, isn't it? So we are not transferring the asset from us to insurance company. It is completely damaged. In this case, we are going to get a claim that compensation. So though there is no transfer of asset, but it is a transfer. Like that, for example, another one, compulsory acquisition. See, voluntarily we are not going to sell the property. We are not going to transfer the property. The government is just compulsory acquiring our property. In this case, also a transfer. So that means a transfer is having a wider connotation. But as for Act, if you are able to prove that it is not a capital asset, it's not a transfer, then there is no question of a capital gain. Okay. But now, how to avoid capital gains is a very, very important thing. Assume I am selling one house property and it was acquired by me, say 5 years back or 10 years back for say 10 lakh. Okay, but now I'm going to sell it for say 18 lakhs or 20 lakhs. But now the difference between this and that is going to be capital gain. As I already told you, it will be taxable at the rate of 20%. So I don't want to pay capital gains tax, the tax on capital gain. How to avoid? So we have to just see the tax planning, which is just given in the Income Tax Act 1961. What are the exemptions in respect of capital gains? First one, if you are able to prove to the satisfaction of the income tax officer that it is not a capital asset, automatically will be coming out of the ambit of capital gains. Point 2, if the exemption, if the particular transaction is not to be treated as a transfer, then it will come out of the capital gains. So first point, we can get the exemption if you are able to prove to the satisfaction income tax officer that it is not a capital asset. 2, if the transaction between the transfer and transfer is not a transfer, then we can come out of the we can come out of the taxability of a capital gains. Third one, Section 10 of the Income Tax Act. Section 10 deals with the exemptions in respect of various income. There are some specific sections at Section 10, subsection 37 and 37A, which are just dealing with the capital gains exemption. That is third one. So under these three cases, we can just come out of the taxability of capital gains. The fourth one is very, very important. That is exemptions in respect of capital gains. That means after the transfer, if you're going to comply to the conditions given in those sections, we can just get the exemption either partially or fully. That is a partial exemption or full exemption in respect of capital gains under various sections. That means there are certain sections, if you're going to get the capital gain, we can claim by choosing the appropriate sections. There are 54, section 54, section 54B, then section 54D, then section 54 EC, then section 54F, then G, GA, and GB. These are the various exemptions specifically given in the Income Tax Act to enable the assessee to claim the exemption. But now I am going to deal with the exemptions in respect of capital gains, right from section 54 to section 54 GB. Let me just to take the first section 54. Section 54 says that if the assessee is going to have any long-term capital gain, as I already told you, long-term capital gain in the sense, what is a long-term capital gain? Any gain which arises over the long-term capital asset. Then what is long-term capital asset? Normally, after if the asset is sold after 3 years, then it will become long-term from the date of acquisition. In the case of immovable property, 2 years. In the case of bonds, shares, securities, then 1 year. So in section 54 deals with exemption in respect of residential house property. That means the assessee is getting the long-term capital gain on the sale of residential house property. That means he is having one residence for residential purposes. I mean, he is having one property for residential purposes. Now he is just selling it for some consideration. Then after selling that particular asset, he is getting some capital gain. And now, as I already told you, long-term capital gain is going to be taxable at the rate of 20%. Suppose even if it's going to get a 1 lakh gain, long-term capital gain, so 20,000 rupees he has to pay as income tax. So to avoid that, what he should do, that is section 54 deals. This section 54 is applicable only to individuals and the HUF. That is individuals from Hindu undivided families. If the individual, let us just take only the individual. One individual is having a residential house property. Now he is selling it for consideration, getting the long-term capital gain. He wants to avoid. That means he doesn't want to pay income tax at all. What he should do? Act says, if the capital gain, whatever the capital gain you are getting is invested in the purchase of new house property 1 year before the transfer or 2 years after the transfer. That means the new property. That means after selling the old property, he is supposed to purchase a new house property. Even he can just 1 year before the transfer. That means what? Before selling this property, he can just purchase one more property 1 year before the transfer or 2 years after the transfer. If at all he wants to construct a new house property, he has to construct it within 3 years. So please understand, my dear friends, that whatever the capital gain, not the sale consideration, whatever the capital gain is for example, I told you, 1 lakh. Say, for example, 1 crore. 1 crore, 20%, 1 crore, then sale consideration is, purchase value is 20 lakhs. He's getting the gain of 80 lakhs. So that 80 lakhs he has to invest, not the entire amount. The capital gain is invested in the new house property. If at all he wants to purchase, then he can comfortably purchase 1 year before the date of transfer or 2 years after the transfer. If at all he wants to construct, he should construct it within 3 years from the date of transfer. Then whatever the amount which is utilized for the purchase or construction of the new house property will be exempt under section 54. If he is going to put the entire capital gain in the new property, the whole capital gain is going to be exempt. Suppose he is able to invest only the 50% of the capital gain, to that extent he may get the exemption. That means the exemption is depending upon how much of the capital gain which is invested in the new house property. Then actually the important point is, suppose he has just constructed, he has got the exemption. Then one more restriction is there. What are the new house property which has been either purchased or constructed, he should not sell it within 3 years from the date of acquisition of the new house property. That means he should just keep the new house property at least for 3 years. You may ask me, suppose if it is sold, what will happen? Then what are the exemption is claimed would be withdrawn. So what are the gain, what are the exemption is claimed under section 54 would be automatically withdrawn at the time of the sale of the new asset. So it is very clear. He can claim the exemption up to the amount invested, up to the amount of capital gain invested in the new asset. The new asset should not be sold within 3 years. So two important conditions you should keep in your mind. He should purchase, see, after selling the old property, he can purchase within 2 years or he can construct within 3 years. Then he can comfortably claim the exemption. Once the exemption is claimed, everything's over. You should keep that a new asset at least for 3 years. If it is sold within 3 years, then automatically you'll be losing the exemption. That is section 54. One more point you can ask me, sir, can he purchase house property in a foreign country? So it has been made very clear in the Act, the new house property should be bought only in India. That means if he's going to purchase house property outside India, the assessee, that is being individual or HUF, cannot claim the exemption under section 54. It has been made very clear. You have to purchase only in India. Then, one more, suppose you may ask me, sir, whether he can buy 2 houses, whether he can construct 2 houses. For example, the assessee is having 2 sons. For those 2 sons, whether he can, he can purchase or construct any, 2 houses instead of 1 house. That is possible if the capital gain does not exceed ₹2 crore. Very important point. If the capital gain exceeds 2 crore, then he has to buy a new house of only 1. If the capital gain does not exceed ₹2 crore, he can just buy, he can purchase or construct a new houses. One more point, whether the property should be purchased only in the name of the assessee, it is not necessary. The property can be purchased in the name of a spouse or sons or daughters, absolutely no problem at all. So, though the original property, though the first old property was transferred by the concerned individual, the new property need not be purchased in the name of the assessee. Instead, he can just purchase in the name of any person, absolute no problem. It is not a hindrance in claiming the exemption under section 54. So these are the provisions related to section 54, which is the exemption in respect of sale of residential house property. So what is the crux of this particular exemption? He should sell one residential property, then he should purchase a new residential property. If at all he wants to purchase within 2 years after the transfer of original property, he should purchase, or within 3 years he should construct. What is the amount of exemption? How much exemption? How much capital gain is going to invest in the new asset? To that extent, he can claim the exemption. And one more restriction is the new property should not be sold within 3 years. If the capital gain doesn't exceed ₹2 crore, then he can purchase 2 houses, and it is not necessary that it has to be purchased only in the name of the assessee. He can just purchase in the name of any person. And very important or mandatory provision is that it must be purchased only in India. That is section 54. Then next is section 54 capital B. The first one is section 54. Now we are just moving to section 54 capital B. And one more point, section 54 deals with only the long-term capital gain. For example, I bought one house property some time back within 1.5 years. I already told you in the case of immovable property, if the property is transferred after 2 years, it will become long-term. So within 1.5 years, I wanted to assume I purchased on residential house property. Within 1.5 years, I'm just selling it. Then it will be a short-term capital asset. For short-term capital asset, you please understand section 54 cannot be, the exemption cannot be claimed. So for claiming section 54, you please understand that the property, the residential property which is transferred should be a long-term capital asset. So for short-term capital asset, the section 54 exemption cannot be claimed. Next, I am passing to section 54 capital B. This section 54 capital B is applicable both the long term or short term. Absolute no problem. Okay. But now to claim this exemption, what is the condition? Very important condition is if either long term or short term capital gain arises on the transfer of land used for agricultural purposes. Nothing but agricultural land. If I'm having agricultural land, please understand I'm selling it. Whether it's a long term or short term, I can claim section 54 capital B exemption. So what is the very important condition? Act has made it very clear that particular agricultural land must have been used for agricultural purposes either by the assessee or by his parents at least for 2 years before the date of transfer. Very important. That means, for example, if I'm just selling today one agricultural land, which is either short term or long term, absolute no problem. But the condition is I should have utilized that particular land must have been utilized by me or by my parents at least for 2 years for agricultural purposes. Then only I can claim exemption. Okay. What is the amount of exemption? Simple. Whatever the short term or long term capital I'm getting, if I'm going to just invest in the new agricultural land, please understand, my dear friends, it is very clear the land must have been utilized for agriculture purposes, and what the new land I'm going to purchase also should be for agriculture purposes. Very, very important. So I must purchase a new agricultural land within 2 years from the date of transfer of the original asset. So these are two conditions. Previously, it should have been utilized by me or by my parents for agriculture purposes at least for 2 years before the date of old asset, older land. And after the sale of the older land, the new land I have to purchase within 2 years. Then, if I'm going to invest the entire capital in the new asset, whole capital gain is going to be exempt. If I'm going to apply only the 80%, I can get a 80% exemption. That means the exemption will be confined to the amount invested in the new agricultural land. And one more important condition is the new land. Actually, we should not say new land. It's a new agricultural land should not be sold within 3 years from the date of purchase. If it is going to be sold within 3 years, automatically what the exemption claimed by the assessee would be summarily withdrawn by the assessing officer. So that means we have to keep the new agricultural land at least for 3 years. So it must be purchased within 2 years from the date of sale of the old land, and the new land should be kept by the assessee or should be held by the assessee at least for 3 years. If it is going to be sold by the assessee within 3 years, automatically what the exemption is claimed would be withdrawn under section 54B of the Income Tax Act. So please understand, section 54B deals with sale of agricultural land and purchase of a new agricultural land. You please remember you can just note down the difference between the 54 and 54B. 54B deals with what? Sale of residential house property and purchase of a new residential house property or construction of a new residential house property. 54B says what? Sale of agricultural land and purchase of the new agricultural land. And next one, 54D. This particular exemption is applicable only to industrial undertaking which are having land and building used for industrial undertaking purposes. That means for business purposes. So 54D, it is not applicable to either individual or HUF, nothing at all. Any person who is having industrial undertaking, having land and building used for his business or industrial undertaking. And that too, this particular exemption 54D is applicable any capital gain, whether it's a short term or long term. But the asset must be a land or building. Next point, that land or building should have been utilized for industrial purposes. That means the land and building must be forming part of the industrial undertaking. Suppose AN company is there and they're having some land and building which is not at all connected to this particular industrial undertaking. If they're going to sell it, then there is no question of 54D. 54D is applicable. Point number one, it must be the assessee must be an industrial undertaking. Point number two, the particular industrial undertaking is selling the land and building which are forming part of the industrial undertaking. the land or building or land and building must be utilized or must have been utilized for the purpose of industrial undertaking. This is a very, very important point. And one more point, okay, how long the particular land and building should have been utilized for industrial undertaking? Act has made it very clear, so it should be utilized. Act has made it very clear, that is, before the date of transfer, it should have been utilized for at least 2 years. That means the land and building should not have been utilized for 5 years or 6 years like that. At least for 2 years, if the land and building have been utilized for industrial undertaking, that is a very, very important condition. Okay. But now, Act says assessee should not sell it. The assessee must transfer this land and building only by way of a compulsory acquisition. You may ask me, what is this compulsory acquisition? The government needs land and building. Then, for example, the government needs that particular land and building. Then immediately the government will issue the order to the concerned assessee to just surrender the land and building. That is called compulsory acquisition. Then they'll give the compensation. Of course, the compensation will have to be treated as a sale consideration. So the very important point is there must be an industrial undertaking, point 1. And point 2, that industrial undertaking must have utilized the land and building at least for 2 years. Then the land and building are going to be surrendered to the government or any appropriate authority by way of a compulsory acquisition. Okay. So now how the exemption? Very simple. Whatever the compensation, how to compute the capital gain? Very simple. Here, this is any capital gain. It need not be a long-term capital gain or something else. Any gain, either you are getting short-term capital gain or long-term capital gain. Okay, how to claim the exemption? Whether short-term capital gain or long-term, and how much you are going to invest in the new asset. This case also, we have to invest in the new assets. Okay. But now, after selling actually it's not selling, it's a compulsory acquisition. So any land or building forming part of the industrial undertaking have been compulsorily acquired by the appropriate authority or by the government or whatever maybe on compulsory acquisition, then you have to compute the capital gain. How to compute the capital gain? Very simple. Complete whatever the compensation you are receiving minus cost of the asset. Cost of such land and building equal to what? Either short-term capital gain or long-term capital gain. That short-term capital gain or long-term capital gain must be invested in the what? New land and building within 3 years term. Either you have to purchase a new land or you want to purchase a new construction. You want to construct a new house property. Property. Then anything you have to do within 3 years from the date of the compulsory acquisition. So please understand, in this case, it must be an industrial undertaking, having land and building, then forming part of industrial undertaking. It is compulsory acquired by the government or any other authority. Then you are getting capital gain. That short-term capital gain, long-term capital gain must be invested in the purchase of land or construction of a building within 3 years from the date of a compulsory acquisition. If you are going to invest or if you are going to utilize the entire capital gain, whole capital gain is going to be exempt. Suppose you are going to use only the 60% of the capital gain, you can claim the exemption up to 60%. And as usual, one more condition: the new land and building purchase after the compulsory acquisition, please understand, it cannot be sold within 3 years. So I think that you would have just seen the compulsory conditions under 54, 54B and 54D. The new asset should not be sold within what? 3 years. So the government, actually the Act insists this particular aspect. The new asset should not be sold within 3 years. So 54B deals with any type of capital gain, point 1. Point 2, it may be any type of capital gain means either short-term or capital gain, but condition is it should not be a separate asset. These are the lands or buildings must have been utilized for industrial undertaking purposes, that is for business purposes. So assessee must run an industrial undertaking. For his industrial undertaking, he was utilizing a land and building at least for 2 years before the date of the compulsory acquisition. And one more point, for claiming 54D, you cannot sell it on your own motion or on your own volition. It must be transferred by way of a compulsory acquisition. Through compulsory acquisition only, you have to surrender your land and building to the government or any appropriate authority, then you are claiming the compensation. That compensation minus the cost equal to the short-term capital gain, long-term capital gain. Absolutely no problem. Then the short-term capital and long-term capital must be invested in the what? New land and building. And new land and building should not be sold within 3 years. That is section 54 capital D. Then 54 EC. So assume one associate doesn't want to just put the money in a land or building. He wants to just buy some bonds or securities. Then we have to apply section 54 EC. This says you are getting only long-term capital gain on sale of land and building. Okay, you are selling land and building, but it must fetch long-term capital gain. Then after getting the long-term capital gain on sale of land and building, you don't want to buy any new land and building, nothing at all. Absolutely no problem. You can claim section 54 EC if you are able to invest that particular money in some specified bonds or securities. That is section 54 EC. So very important point is that capital gain should be invested in the bonds of, very important, National Highways Authority. That is the bonds of a National Highways Authority of India, then Rural Electrification Corporation, then Power Finance Corporation, or any other bond notified by the government. Then what is the time frame for investment? Normally the government in the other cases and all, if the purchase is for if it is purchased 2 years, normally used to give construction 3 years, like that and all. Here there is no years. That means that I mean for the new investment, they are not giving any time of 1 year, 2 years, like that, within 6 months. This is a salient feature of section 54 EC. After getting the long-term capital gain on sale of land and building, then the long-term capital gain should be invested in the specified securities, especially National Highways Authority of India, then Rural Electrification Corporation, then Power Finance Corporation, then any other bond notified by the government of India in the official gazettes. In these bonds and all, you have to invest within 6 months. Very important. Okay. If you're going to buy those securities or those bonds, then you can claim the exemption up to the level it is invested. If you're going to invest the entire, for example, I'm getting the long-term capital gain of say 10 lakhs. The whole 10 lakhs I'm going to buy the bonds. Then the whole 10 lakhs is going to be exempt under section 54 EC of the income tax side. Out of 10 lakhs of long-term capital gain, if I'm going to invest only the 8 lakhs, I can claim the exemption only up to 8 lakhs. That means under 54 B or D or EC, only the assessee will have to invest the capital gains. The capital gain must be invested in the new assets. In this case, 54 EC, new bonds, new securities. Then within 6 months, he should invest. How much he is going to invest? To that extent, he is going to claim the exemption. And very important point is, as usual, the new bonds or securities should not be converted into money within 3 years. If it is converted, automatically the exemption would be withdrawn. But normally, these I told you, the National Highways Authority of India, these are the bonds which are redeemable after 5 years only. So absolute, so normally this is redeemable after 5 years. Suppose if there's any option for the conversion of money, if the conversion of bonds into money, they're going to get it converted, then automatically the exemption will be withdrawn. That means you have to hold those securities or bonds at least for 3 years. So within 3 years, if you're going to convert into money, what are the exemption you have claimed under section 54 EC would be summarily withdrawn. Then we are entering into very important section 54F, that is exemption in respect of long-term capital gain in respect of transfer of any asset. But you have to buy the new asset of residential house property. You please understand, my dear friends, the difference between 54 and 54F. In 54, we have to sell residential house property, then we have to buy the new residential house property, okay, or you have to construct the new residential house property. In this case, you have to sell any property other than residential house property, but while you are buying or while you are constructing, you have to do only with respect to house property, that too residential, that is, residential house property. So understand the concept of this 54F. You can sell anything, land, okay, or commercial building, whatever may be and all, but you should not sell residential house property. Other than residential house property, you just sell even furniture, fittings, okay, plant, machinery, etc., etc. But you have to buy the new residence. So our act encourages the assessee who do not have any residential house property, okay, but having some other properties, then he can just sell and buy the new residential house property. That is a sell in future. And one more point that I forgot to tell you. Under section 54 EC, suppose I'm getting I told you just now, I told you we can just invest within the, under the, bonds of this National Highways Authority or something and all. Suppose people are getting the gain of long-term capital gain of 3 crore, 4 crore and all, they cannot just invest in bonds. Act has made it very clear. The new investment under 54 EC, the preceding section, the investment should not exceed rupees 50 lakhs. That means each section 54 EC exemption is restricted to 50 lakhs. You can claim the exemption. That means the new investment on bonds cannot exceed rupees 50 lakhs. In the sense, 80 EC can be claimed only up to 50 lakhs. Though you invested 1 crore or 2 crore or 3 crore, you can claim the exemption of 54 EC only up to rupees 50 lakhs. That was made very clear by the Act. Now, 54F. Just now I told you, you can sell any asset, but you have to purchase or construct a new asset. Okay, but now what you should do? I told you in all our preceding exemptions, we are just seen only the capital gain is to be invested, not the entire sale consideration. But this is a unique section. You should just keep in your mind. Here, the net sales consideration. What is the consideration? Amount received from the transferee. So the consideration itself is going to be invested in the new residential house property. That is the salient feature of this particular 54F. 54, 54B, then 54D, then 54 EC. We have just seen only the capital gain. It is enough to invest only the capital gains. But under 54F, we have to invest a sale consideration. Okay. So in what way we have to invest? I told you we have to purchase a new residential house property or what? We have to construct a new residential property. And the very important point is what asset you are transferring should not be a residential house property. Suppose one assessor is selling the residential property and buying the new residential property, automatically can claim the exemption under 54, but not under 54F. To claim 54F, what asset you are selling should not be a residential property. Okay, but now one assessor is selling one plant or a machinery. Any asset other than residential property is just investing. But now he has to buy the new residential property. So in this case, he should purchase 1 year before the sale of the asset. That means even before selling this new old asset, he can just keep one. Already he can purchase 1 year before the transfer of the. For example, he is selling one machinery, and at the time of machinery, already he has purchased one house property. That is enough to claim 54F. That means it is not necessary you have to buy or construct. Construction is a different one. You have to buy only after the transfer of the original asset, or after the transfer of the old asset. Even before the 1 year before the transfer of the old asset, you can just buy it for the purpose of claiming under 54F. So 1 year before or 2 years after the transfer, or if at all the asset, the new residential property is going to be constructed, you have to construct it within 3 years. So the time frame for the new investment in residential house property is 1 year before. 1 year before is a very, very rare phenomenon. So 1 year before the transfer or 2 years after the transfer, you have to buy a new residential house property. If at all you want to construct, you have to construct it within 3 years. This is the very, very important provision of this particular section 54F. But I already told you, I made it very clear that consideration is to be invested in the new residential house property. Okay. Suppose, if the assessee is able to, so he is supposed to invest consideration, not the capital gain. So what are the amount which is received from the transferee or the buyer? Then entire amount, suppose one fellow is selling machinery, he is getting 10 crore. The entire 10 crore, if he is going to invest, capital gain is a different capital, don't bother with the capital gain. What are the amount which has been received as consideration? The entire consideration must be invested in the purchase or construction of a new residential house property. If the entire consideration is invested, then he can claim the full exemption. You may ask me, sir, suppose he is unable to invest the entire consideration, what will happen? Then we have to give the proposed exemption. What is our meaning of proposed? Exemption: amount invested divided by sale consideration into capital gain. So in the case of 54F, essentially we have to calculate this particular formula. Suppose assessor is able to prove to the satisfaction of income tax officer, he has invested the entire sale consideration, then he can claim the full exemption. Suppose partly, then we have to apply this particular formula. Out of the total consideration, how much he has invested? For example, 60%. Then he can claim the 60% of the capital gains under section 54F. So you please understand, my dear friends, even though the assessor is investing the full capital gains in the new residential house property, he cannot claim the full exemption. Please understand, it has to be noted that the entire consideration must be invested in the new residential house property for the purpose of claiming section 54F exemption. Otherwise, then we have to just find out, apply this formula, so that particular exemption will be proportionate, or the exemption will be extend to the amount amount of consideration invested in the new residential house property by applying this particular formula. And very important thing, suppose on the day of transfer, our act says before the day of transfer you can just buy. That means what? I'm selling one machinery today. So today I can just purchase, or 1 year before the date of transfer. Today I am selling one machinery. So from this particular date, within 1 year from the day, before 1 year, I can just buy one house property for the purpose of claiming the exemption under 54. Yeah. Then very important point is, Act has made it clear. Where suppose assessor has bought 2 house properties before selling the machinery, whether he can claim the exemption or not, then Act has made it very clear. Yes, one more property he can have. So that means what? He can have 2 properties. One property not for claiming exemption under 54, one property for claiming exemption under 54. So before the date of sale of the original asset, that is other than house property, he can have 2 properties. One is for claiming exemption 54 and one more property is allowed. That means assessee can have 2 properties before the date of transfer of the original asset. Original asset in the sense what? Other than house property. But in the normal case, construction or something, after the date of transfer, you should purchase one particular house property, and after, for the construction 3 years. But before the date of transfer, Assessee Act says he can just buy 2 properties. One property for claiming 54F and another property for his own use. That means actually what I told you, it is a section to encourage the assessees to buy the house properties. He can sell any property other than house property, but he should just buy the house property. Actually, he is supposed to purchase or construct only one house property. So recently it was amended, then he can just have one more property even before the date of the sale of original properties. And a very important point is, transfer has been made. Then he has claimed the exemption. Everything is over. Act has made it very clear. After the transfer, other than what he has purchased or constructed for the purpose of claiming exemption, he is not supposed to buy any new house property within 2 years, and he should not construct any new house within 3 years. So in the one particular case, he has sold one plant or machinery, then he bought or constructed one house property, well and good. He can claim the exemption. Assume he has claimed he has just invested the entire net sales consideration. Yes, he has got the exemption 54. Yep. Then after buying the new house property, other than the new house, within 3 years, within 2 years, he should not purchase any new house property, and within 3 years, he should not construct any house. That means after the date of transfer, he is not supposed to buy any new property. He is not supposed to construct any property. What's the time limit? After 2 years or after 3 years, he can purchase. But until that, within 2 years, he should not purchase, and within 3 years, he should not construct. That is very important condition. What may happen if he's going to violate? Then automatically, what the exemption is claimed under section 54 will be summarily withdrawn by the assessing officer. So this is very important point. 1 year before is okay. That means Act allows one property even before. So Act allows two properties. One property for this for claiming exemption, one property for his own use. He can have two houses, but before the transfer. But after claiming exemption, he is not supposed to buy new property within 2 years. He is not supposed to construct any new property within 3 years. That means to retain the exemption, further purchase or further construction 2 years or 3 years, he should not commit. If he's going to commit, automatically the section 54F exemption will be summarily withdrawn. So these are the various exemptions under capital gains. So very important point is, in the case of 54D, I made it very clear. You can just any under 54D that's industrial undertaking, any capital gain you can use. But other than these things, most of the sections are dealing with only long-term capital gains. I told you, so only 54B and D, you can claim these two sections, two exemptions, both for short term and long term. But 54, then 54EC, then 54F and all, only long term capital gains. So this is very important thing. If at all, for example, I'm getting one short term capital gain, I want to claim the exemption, I have to seek either 54B or 54D. Okay, to claim 54B, what is the condition? It must be an agricultural land. For claiming 54D, what is the condition? I must have land and building forming part of the industrial undertaking. So other than this, 54, selling residential house property, buying residential house property. What is 54EC? Selling land and building, buying bonds. Then what is 54F? Selling any asset other than house property, but buying a new residential property. So these are the exemptions which are just being claimed in respect for capital gains under various sections. As I already told you, how to circumvent the provisions of capital gains, or how to avoid the taxability of a capital gain is a first point, as we have to prove then it is not a capital asset. Point number 2, we have to prove that transaction is not a transfer. Point number 3, we can claim exemption 37 that is insignificant, section 10, 37 and 37A. Okay. And 4 is legally. Legally, we can claim these exemptions provided if you are going to make the investment given under the concerned act or concerned section. So if you're going to comply to the provisions of those sections, if you're going to comply to the conditions given in those sections, we can comfortably claim section 54, 54B, 54D, 54EC, and 54F. These are the 5 important sections at your level are the exemption in respect of capital gains. As I already told you, long-term capital gain is going to be taxable normally at the rate of 20%. But then you may ask me, sir, one person has got the 5 lakhs as a long-term capital gain. So we have to claim just 20%. So 5 lakhs in 20%, the 1 lakh he has to pay as a long-term capital gain tax. No. Act says if he does not have any other income, out of this 5 lakhs of long-term capital gain, the initial exemption of 2.5 lakhs may be deducted only in the case of resident assessees. See, a lot of people do not know. They are thinking that straight away long-term capital gain into 20%. No. Long-term capital gain minus tax exemption. You know the minimum exemption 2 lakhs. That is applicable even in the case of long-term capital gain, only for the resident assessees, but not for non-resident assessees. So whatever the long-term capital you are going to get, then from that you can, if provided you are not having any other assets, I mean any other income. Suppose you are having salary income or something, and already you have claimed this 2,03,000 exemption. Again, you cannot claim it. So if you do not have any other income, then the initial exemption of 2.5 lakhs may be deducted from the, for example, in this case, 5 lakhs long-term capital gain minus 2.5 lakhs. Only this 20% we have to apply on the remaining 2.5 lakhs. That is the important provision we have to keep in our mind. So these are the exemptions given under capital gains. If you are having any query, you can just ask me, please.
Dear students, if you have any questions, please. Anyone? Yoshiri, Mauli. Any questions from anyone?
Yes, sir.
Yes, sir. You have any questions?
No, sir.
Thank you, ma'am. Thank you.
So students are able to just absorb, are able to just imbibe the provisions of the exemptions, please. Is there any ambiguity?
Not like.
You want any clarity? Shall I just assume that you people have understood fully the implications of the exemptions?
So I hope I also thought yes.
Thank you, sir. Thank you, sir.
Okay, sir. So no questions from the student side. So shall we come for an end? Okay, sir. Sir, do you have any other information, sir? Or otherwise shall we wind up?
Right, sir. I think these are the, so because I was just told by your professor that I have to confine to this exemptions.
Okay, sir. Thank you. Dear students, any questions from your side? Okay, sir. So no questions. So I hope all of you understood the brief input.
Professor, sir, if you're just, I mean, you will be just meeting them at your class. You just ask them whether they were in a position to observe the things.
Yes, sir.
So I request you to send your, I mean, the feedback of the students to me, please.
Okay, sir. I'll forward, sir, later. Once again, thank you, Baskaran sir, for accepting our request for be here for on this particular occasion. So I believe personally, on behalf of Department of Commerce, my co-faculty organizer, Dr. G. Velmurugan sir, I thank personally once again. I hope all my students, even I shared the link for even other batch students also. Hope most of you have watched this particular session. So all of you got a brief input on the capital gains and its exemptions. It is one of the very important topic under income tax. So whenever you are going to have a capital asset at the time transferring, so what kind of exemptions you can avail based on the capital gain what you earned. So with this short note, so I thank once again Baskaran sir. So we will meet you once again with another new topic. Thank you, sir.